I review business owner tax returns every week, and there are 7 things I look for almost every time. Some are pretty common. Some can reveal planning opportunities worth hundreds of thousands of dollars over time. And one of them is an account buried inside many business tax returns that most owners have never heard of. For context, I grew up around family-owned businesses, heating oil, excavation, and auto body shops. I started my own landscaping company as a teenager. Today, I spend most of my time helping business owners coordinate taxes, retirement planning, and long-term wealth decisions. Now, this isn't criticism of CPAs. Most CPAs are hired to prepare returns, maintain compliance, and accurately report what happened during the year. Their work matters. What I'm doing is different. When I review a tax return, I'm trying to identify opportunities, blind spots, and questions worth asking. Let's start with the first thing I look for. Clue number 1 is charitable contributions. One of the first things I review is charitable giving. Are charitable contributions showing up on the return? If so, how much? I recently reviewed a return for a business owner who had been making a significant charitable gifts every year. Nothing unusual there. In fact, I love seeing that. But the question I asked wasn't how much they were giving, how they were giving it. The return showed me the deduction. It didn't show me the strategy. And that's an important distinction. Sometimes the most valuable planning conversations start because the return points us toward a question worth asking, not because it gives us an answer. All right, remember that account I mentioned at the beginning? This is it. If I'm reviewing an S-Corp return and I see a significant AAA balance, it immediately gets my attention. AAA stands for Accumulated Adjustments Account. Most business owners have never even heard of it. In simple terms, it often represents earnings that owners have already paid taxes on, but have not yet distributed from the company. Now, that doesn't automatically mean anything is wrong. It doesn't automatically mean anything should change. But it tells me there's a story worth understanding. Why has that balance accumulated? What role is that money serving inside the business? Does it still align with the owner's goals? Those are the conversations that matter. Now, every situation is different, so don't make planning decisions based on a YouTube video. Run ideas by your own advisors. Or, if you'd like a second opinion, schedule some time on my calendar below. All right, number 3, retirement plan contributions. Next, I review retirement plan contributions. And for many business owners, this is one of the largest planning opportunities available. Do they have a 401k, a profit sharing plan, a cash balance plan, or are they making little to no retirement contributions at all? I reviewed a return not long ago for a business owner generating several hundreds of thousands of dollars of profit every year. The interesting part wasn't what I found, it's what I didn't find. There were no meaningful retirement plan, no profit sharing plan, no cash balance plan. Now, the CPA had done a great job. The return was accurate, but nobody had stepped back and asked whether the current structure still made sense. When you're making $100,000 a year, that's one conversation. When you're making $500,000 or $1 million a year, it's a completely different conversation. And if you're listening to this and wondering whether there are opportunities hiding in your own situation, this is exactly the type of thing we discussed during our introductory meeting. We'll talk through your goals, your business, and determine whether a tax strategy review even makes sense for you. There's a link below, but let's keep going. All right, number 4. The next, I spend time reviewing the capital gains schedule. This section often tells me whether tax management is being incorporated into the investment strategy. One thing I'm looking for is tax loss harvesting. Now, tax loss harvesting isn't a magic trick. It doesn't eliminate taxes forever, but it can create flexibility. When markets decline, investors sometimes have opportunities to realize losses that may offset other gains. When I review returns, I often see one of 2 situations. Losses have been harvested strategically over time, or very little tax management has taken place at all. Neither is automatically right or wrong, but it tells me something about how the portfolio is being managed. Those details can become important when someone eventually sells a business, sells real estate, or experiences significant liquidity event. Number 5, tax-free versus taxable interest. Another area I review is interest income. Specifically, I want to understand how much interest is taxable and how much is tax-free. Why? Because tax brackets matter. A strategy that makes sense for one person may not make sense for another. If I see substantial taxable interest income, I start asking questions. Where's it coming from? What types of investments are generating it? Is the portfolio being managed with taxes in mind? The return won't answer those questions, but it tells me where to start looking. Clue number 6 is carry forward losses. The next area I review is carry forward losses. This is one of the most overlooked sections of many tax returns. Sometimes losses from prior years don't disappear. They carry forward and may potentially offset future gains depending on the circumstances. When I see carry forward losses, I want to understand three things. Where did they come from? How much remains? And are they being incorporated into future planning decisions? Many business owners don't even realize these carry forwards exist, yet they can become incredibly valuable when a significant gain occurs later. A business sale, a real estate transaction, concentrated stock position, the return helps identify opportunities that may otherwise go unnoticed. And clue number 7 is standard versus itemized deductions. The final area I review is whether someone is taking the standard deduction or itemizing deductions. For many people, this isn't particularly exciting, but for others, especially retirees who are charitably inclined, it can create planning opportunities. For example, if someone is over RMD age and already making charitable gifts, I want to understand how those gifts are being made. Could there be a more efficient way to accomplish the same goal? Possibly. The point isn't that everyone needs a new strategy. The point is that a tax return can help identify whether a conversation may be worthwhile. Here's the reality. A tax return is one of the few documents where your business decisions, investment decisions, retirement planning, and charitable giving all show up in one place. Most people look at a tax return and see forms. I see questions, I see patterns, and occasionally I see opportunities that deserve a closer look. Not because anything was done incorrectly, not because the CPA made a mistake, but because nobody had taken the time to connect all the pieces together. Preparation asks, what happened? Planning asks, what should we be asking next? If you'd like a second set of eyes on your situation, schedule an introductory meeting using the link below. We'll talk through your goals, determine whether a tax strategy review makes sense, and see if there are any opportunities worth exploring. Because sometimes the biggest opportunities aren't hidden in complicated strategies. They're already sitting inside the tax return you filed.